The soft landing is dead. The Goldilocks economy has been dragged into the alley and shot. If you are looking at your screen wondering why the futures are bleeding out, here is the cold, hard reality. The ghost of the 1970s has just walked through the front door of the New York Stock Exchange. Stagflation. It is the word that every central banker fears. It is the word that destroys portfolios. And as of 8:30 a.m. this morning, it is the official narrative of the U.S. economy. Welcome to this emergency market briefing. I am your host, and we are throwing the previous playbook into the shredder. What just happened with the non-farm payrolls report is not a miss. It is a regime change. Let's dissect the numbers that have paralyzed Wall Street. The November Jobs Report was supposed to show resilience. It was supposed to justify the no landing or soft landing narrative. Instead, we got a disaster. Job growth has collapsed to a record low. The hiring freeze is real. Corporate America has stopped expanding. The engine of the economy is sputtering. By itself, this would signal a recession, and normally, the market would cheer this because it means the Fed would cut rates. Bad news would be good news. But here is the sting in the tail. Here is the poison pill. While hiring collapsed, average hourly earnings exploded. Wages skyrocketed well beyond the most hawkish forecasts. Do you understand the gravity of this divergence? We have a shrinking economy, but the cost of labor is rising. This is the worst-case scenario. This is the wage price spiral nightmare. Companies are earning less, selling less, but paying more to keep their lights on. This crushes margins. This destroys earnings per share. And for the Federal Reserve, this is checkmate. Jerome Powell is trapped. He cannot cut rates to save the dying economy because wage inflation is raging. If he cuts, inflation goes hyper. If he holds or hikes, the recession deepens. He is paralyzed. And a paralyzed Fed means the market is on its own. What does this mean for your money? It means the entire valuation model of the S&P 500 is wrong. For the last 2 years, you have been buying stocks based on a specific assumption that inflation would cool and the Fed would cut rates to 3% or 4% by 2025. That assumption is now mathematically impossible. Wall Street is frantically repricing the yield curve. The market is now waking up to the realization that interest rates might have to stay restrictive not just through 2025, but deep into 2026. This is kryptonite for the stock market. Specifically, this is the death knell for growth stocks. If you are holding a portfolio heavy in big tech, the AI darlings, the cloud computing giants, the semiconductor leaders, you are standing in the kill zone. Why? Because these are long-duration assets. Their value is based on profits they will make 5 or 10 years from now. When you discount those future profits back to today using a higher interest rate, the present value of those stocks collapses. It's simple math. Higher rates for longer compress POE multiples. A stock trading at 30 times earnings might make sense in a low-rate world. In a stagflationary world, that same stock belongs at 15 times earnings. That is a 50% haircut. That is the repricing risk you are facing right now. We are tracking the flows of the smart money, the hedge funds, the sovereign wealth funds, the family offices. They are not waiting for the opening bell. They move the second the data hit the wire. They are engaging in a violent rotation. They are dumping risk and buying yield. They are thumping the sell button on the NASDAQ and parking capital in short-term U.S. Treasuries. Why risk your capital in a volatile tech stock for a potential 8% gain when the 2-year Treasury is about to offer you a risk-free 5.5% or 6%? The risk-free rate is becoming the biggest competitor to the stock market. Furthermore, look at the commodities sector. If the dollar loses purchasing power due to wage inflation, but growth is slow, where do you hide? You hide in things that you can drop on your foot: gold, copper, oil, real assets. We are seeing a massive inflow into the commodity indices. This is the classic 1970s playbook. When paper assets, stocks, bonds, fail, hard assets reign supreme. The scariest part of this morning isn't the data, it's the denial. I am seeing retail investors on social media saying, buy the dip. They are saying, the Fed will save us. Let me be crystal clear. The Fed is not coming to save you. The Fed mandate is price stability and maximum employment. They have failed on price stability, wages are up. And they are failing on employment, hiring is down. They do not care about your portfolio. They do not care about the S&P 500 level. They care about not letting the US dollar collapse under the weight of inflation. They will sacrifice the stock market to save the currency. The market sentiment has shifted from FOMO, fear of missing out, to a new, more dangerous phase: liquidity preservation. When stagflation hits, cash flow becomes king. Companies with high debt loads, they are dead walking. They cannot refinance at these rates. Startups burning cash, they are zero. The market will stop rewarding revenue growth and start demanding free cash flow. If a company in your portfolio is not profitable today right now, it is a liability. Let's focus on your tech holdings. You have likely enjoyed a spectacular run. You feel like a genius. But you need to understand that the liquidity tide that lifted those boats is going out. The algorithms that run Wall Street are programmed to sell growth when wage inflation ticks up. It's automated. You are not fighting a human. You are fighting a math equation that says, if wages dx and growth y, then sell tech. We are already seeing the cracks. Look at the semiconductor index. Look at the software service providers. They are leading the decline. This is not a healthy correction. This is a sector rotation. The capital is leaving the casino and going to the bank vault. So, what do? Panic is not a strategy. Preparation is. Open your portfolio. Look at your allocation. If you are 60%, 70%, 80% in technology stocks, you are dangerously exposed. You need to trim. You need to take profits. Do not let a huge winner turn into a loser because you were too greedy to click sell. You are not betraying a company by selling its stock. You are managing risk. If you hold bonds, get out of the long end. Do not hold 30-year bonds. In an inflationary environment, long-term bonds get crushed. Move to the front end of the curve. 3-month bills, 6-month bills. Stay liquid. Cash is not trash in this environment. Cash is an option to buy assets cheaper later. Stagflation favors companies with pricing power, who can raise prices without losing customers. Utilities. Consumer staples. People still need toothpaste and toilet paper. Healthcare. These are the boring stocks you ignored during the AI boom. It is time to make friends with them again. They are your shield. Consider a 5 to 10% allocation to commodities or energy. If wage inflation persists, the cost of goods will rise. You want to own the raw materials, not the companies that have to buy them. The narrative has changed. The Goldilocks fairy tale is over. We have woken up to the bears in the kitchen. The market is currently in the process of repricing risk. This process is painful, it is volatile, and it is swift. The gap down you see today is just the beginning of the adjustment. We need to find a new equilibrium where PE ratios reflect a world of high interest rates and low growth. Do not be the bag holder for the soft landing narrative. That ship has sailed. The waters ahead are choppy, and the storm is called stagflation. Protect your capital, reduce your leverage, and for the love of your financial future, stop chasing the high-flying tech stocks of yesterday. The game has changed. Make sure you change your strategy with it.